and welcome back to Crypto. So today we're going to break down our monthly newsletter. This is a video that we're going to release at the end of each month with our newsletter, in which we're going to break down everything that happened in the markets and what we can expect from the markets and economy going forward. So today we're going to break down our March newsletter, in which we talk all the data and everything that happened in February. So the first thing I want to ask you to Eduardo is what happened in February from the economic data, what is macro telling us, and how are the markets behaving?
Yeah, sure. Well, first of all, the macroeconomic data released in February for the US depict a resilient economy. This is the first point that we need to highlight. This is because, for instance, for the GDP figure of Q4 2022, we see a 2.7% annualized rate of growth. And also, conversely, if we analyze consumer spending, we see a 1.8% increase in January, which depicts like that consumption is still resilient to the interest rate hikes. And finally, concerning personal income, we witnessed a 0.6% in personal income in January compared to a 0.3% that was in December. And this, of course, is not enough to deal with the current inflation rate, which effectively kills the purchasing power of millions of Americans. But overall, we see a clear picture that the economy still seems to perform pretty decently, I would say.
Okay, but what are the market telling us? How are they behaving in reaction to this data? And what we can expect going forward from them?
Yeah. Well, in terms of equities, we witnessed some bullish momentum in the first half of February. Especially here, we analyzed the S&P 500, which touched the $4,200 level. However, this movement was markedly supported by low volumes, as we can see from the chart here. You see much higher volumes back in June, for instance. And we know that when the movement is not supported by high volumes, this is probably a manipulated market. And also in the second half of February, we witnessed a strong correction, which basically brought the level of the S&P 500 to the 0.5 level of Fibonacci, which is a critical level that needs to hold in order to support this bullish momentum. So we see that from October onwards, basically the S&P 500 has been trading inside this rising wedge, but we are really close to the lower bound of this wedge. So we need to pay attention to that.
Okay, and, so we're talking about the economy and other than expected data on the inflation. But why are the market going higher? What is driving this movement to the upside?
Yeah, probably this movement is due to liquidity. So if you can go to the next slide, probably we can see like our model of, first of all, our model of net liquidity is basically given by the Fed assets minus the TGA and the RPF, which are respectively Treasury General Account, which we can simplify to taxes minus government spending. And then we have the reverse repo facilities, which is a metric well known in the financial environment. And well, basically, from this chart, we can particularly see that our model of liquidity basically follows one-to-one the performance of the S&P 500. But as we can see from the last period, net liquidity has been going down while the S&P 500 has been rallying. So from this, we kind of asked ourselves, why is this the case? And effectively, there is one main reason that probably has driven the markets higher in this last month, which is probably the reopening of China. So basically, China has been injecting a lot of liquidity into the market, and this has probably driven the entire financial system overall around the world. So you maybe want to add something on this?
Yeah, definitely. So in our model, we're only considering the Fed and the US as the main driver of liquidity. But however, there are many other forces that you have to consider in the macro markets, such as China, Europe, and Japan. And lately, China has just reopened, And as a consequence of the reopening, they had to inject a lot of liquidity on the system. More specifically, because the economy reopened, there's been a high number of borrowing that drove the borrowing cost of capital higher. So, in order to counteract to inverse this trend and to prevent borrowing costs to go too high, they injected more liquidity into the system, because if the less cash there is into the system, the more borrowing cost there is for people that want to borrow. So by injecting cash, they ensure that the borrowing cost is going to stay lower, and this trend is probably likely to continue in the upcoming months. And it's the main driver that drove asset market higher, especially as you can see from this graph. There's been only the last week around 121 billions of liquidity injected into the market. That's more than offset all the Fed tightening and the net liquidity of our model. So it's always important to factor in also China, and in this case the reopening of China, as a force driving the markets.
Yes, and if I can add a little note on this, if as you can see from the right-hand side the graph, we see that the percentage of consumption, like the percentage of GDP that is related to consumption in China, and we can see that in the past couple of years, this percentage has been increasing up to 55% in 2023. And well, according to our thesis, this is probably not a good a good element for inflation, for inflationary pressures, since consumption usually helps driving prices to higher levels and also contributes to the overall liquidity in the market. So this is perfect. This perfectly fits with our thesis that China has been injecting a lot of liquidity, and this is a direct consequence of it. So the consumption levels of GDP in China has been increasing as well.
Yeah, another note we can add is definitely the correlation that Bitcoin has with the Shanghai Composite Index of stocks. And because, if you're a crypto investor, you know the Bitcoin is a global asset in which the marginal demand not only comes from US, but only comes from China. So we've seen a very high correlation between China markets and Bitcoin. One of the considerations that I would say of this China reopening is, and in its injection of liquidity, is also not only on the stock market, but on the economy. So I think many countries, like they are depending from China, which their economy relies on export to China, are probably gonna have a inflationary force from China that is ramping up demand. So this new reopening of China is good for market, but it's bad for inflation. It's gonna probably cause countries such as Europe, of Korea, of Japan to have a more sticky inflation. They're gonna have like higher PPI and export for at least the coming months. So as it's good in the short term for the injection of liquidity, it can be bad as it can keep inflation high.
Yeah, and related to this, I wanted to ask you, like, do you think the Fed is gonna somehow change its interest rate expectation, in the sense, do you particularly expect further hikes in the coming periods, or do you see like the rates flattening to then decrease eventually?
Yeah, we see in the month of February way hotter than expected inflation, and especially way hotter than expected consumer expenditure, which was, I think, at its highest reading on the last 18 months, which was like 0.6% month over month, signaling that actually the inflation is stronger than expected. Not as easy going down as expected, more sticky than expected. And the market and then finally pricing in what the Fed has been saying for the past few months, which is it doesn't matter how we're still going to go, but how long we're going to stay to these levels. So we've finally seen priced in the Fed Fund future to be at 5.4% by the end of September, but also stay there through the whole month. As a consequence of this, we will see probably market catching up to rates, because as interest rates goes up, usually also stock tends to reprice.
Yes. So you kind of see like a market rotation towards bonds rather than stocks in the coming period?
I would say in general the effects on bonds on the stock market are inversely correlated. So when the interest rates goes up, the markets tend to correct. But the sector that most tend to correct usually are high growth stocks, which are very interest rate sensitive, because they rely on the fact of producing revenue in 10 years. So you have, if the actual interest rates in 10 years is going higher, then you have to discount for that. While defensive or more like healthcare or more cyclical stocks, they tend to perform better when in this kind of high interest rate environment, because they actually produce cash earnings and dividends today. So they are a more safer investment when discounted for interest rate. And yeah, I mean, in general, I would say bonds have been skyrocketing to a all-time high, and this has been the worst years for bonds. 2002 has been the worst years for bonds in over a decade, actually, maybe since the 70s. And this is signaling a shift over environment in which we are not going to see the easy money and growth stock performing that well. And probably even in the short term, right now we're seeing rates skyrocketing to all-time high, so we're probably going to see a correction. But also in the long term, is signaling a bit of a shift of environment that is going to be harder to trade on.
Yeah, this is very interesting. So probably the 60% stocks and 40% bonds composure that we witnessed in the past in many investment portfolios probably is going to be replicated in the future, since of course the bond yields are way more interesting to invest in. But yeah, anyhow, this was pretty much it about our monthly newsletter. So yeah, we're gonna be doing this basically this catch up on YouTube every month. So please make sure to follow us on YouTube, LinkedIn, where we publish our newsletter as well, on Telegram and Twitter. And yeah, I wish you a good day, and see you next time.